Sure.
So, hello and welcome to our webinar on the Singapore Exchange SPAC consultation. This event is kindly sponsored by SoHo Advisors. My name is Claire Wilson and I'll be hosting and moderating our event today. We're going to be recording this session, so I'll share the link with all of the registrants later in the day. We have a stellar panel of experts lined up for you today, but before I introduce our panelists, I'd like to welcome our special guest, Frank Troise, who will also be listening in. As you know, Frank is highly regarded as an expert in the SPAC space, and his views are often sought after as one of Asia's leading voices. Frank is also the founder of SoHo Advisors, the region's leading advisory firm for fintech, enterprise infrastructure, and SPACs. Welcome, Frank. May I invite you to say a few words to open up our event?
Thank you, Claire, and thank you everyone for attending today's event. We are enormously excited about this, especially given the topic and the timing. Real quick, for those who I haven't had the opportunity to meet, who I don't know personally or do not know our firm, we're very honored that SoHo is Asia's leading independent financial advisor for SPACs here in the region. We're the leading strategic advisor and we're the leading research provider. This is important because our independence is crucial to our success. You'll hear myself and my colleagues often refer to ourselves as being completely independent and not beholden to any underwriter. This is very, very important as it relates to our value proposition to both SPAC sponsors, both US listed and in today's topic, sponsors to be listed out here, and for target companies where, as all of you have seen, given the recent Grab Altimeter transaction, suffice it to say that every Southeast Asian company has now effectively gone bid in this environment. We're enormously excited about today, but in addition, I'd be remiss to not inform all of you that on May 4th, we're holding the first inaugural US-Singapore SPAC trade mission event. We're doing this with the US Department of Commerce, the US State Department, and we're enormously excited about this. The event was already oversubscribed in terms of SPAC sponsors and target companies, and we're now in the position where we're going to be holding an additional 3 events before year end. So again, thank you for today. Thank you for giving us the opportunity to be part of this process with you. The timing is perfect. I'm enormously excited to listen in today, given the opportunity now with the Singapore Exchange, asking for feedback as it relates to this framework consultation. Claire, thank you for today and for moderating. Thank you for our guests. And Claire, I'll pass the baton back to you to get started.
My pleasure. Thank you, Frank. And also, I agree, it's a very, very exciting time. So now it's time for me to introduce our stellar panelists. Now, they're both equally impressive in their own right, so I'll go in alphabetical order. First of all, it's my pleasure to introduce you to Michael Avila. Michael has extensive capital markets and exchange experience. He's currently a senior advisor at SoHo Advisors, and from 2018 to 2020, Michael was Vice President and Head of North America Capital Markets at the Singapore Exchange. I'm also especially grateful to Michael for joining us today, as he's based in San Francisco, and it's incredibly late there right now. So Michael, it'd be great if you could tell us a little bit more about your background and your work.
Sure, thank you. So it is pretty interesting getting ready for a panel at 11 o'clock at night here in the Bay Area. But so my background, historically, I spent a little over 10 years as an investment banker here in Silicon Valley. So working with a lot of tech companies, doing a lot of IPOs, a lot of M&A for various firms here. After leaving banking, I then spent almost 5 years with the New York Stock Exchange. So I was part of their global listings group, responsible for building out their listings efforts here in the Bay Area, particularly their listings efforts in emerging growth sectors like technology and healthcare. As Claire pointed out, most recently I was with SGX, which got me a lot of interesting exposure to Singapore. I enjoyed my time as the head of North America Capital Markets at SGX. I left SGX at the end of the year and recently joined Frank over at SoHo.
Thank you so much, Mike. So we're going to be calling you today, Mike, to give us that comparison between the US and the Singapore proposal. So hopefully you've had quite a bit of coffee to keep you awake as well. It's also my pleasure to introduce you to Nick Davies, who's a partner at King & Wood Mallison's law firm here in Singapore. Nick has been recognized as a rising star by Legal 500. In addition to serving his clients, Nick is often called upon to give his expertise in shaping regulatory development in the fintech sector. Recently, he's also contributed to Singapore's model venture capital investment documents. Welcome, Nick. Perhaps you can share a little bit more about your background and work for us too.
Thanks, Claire. So I'm a partner specializing in cross-border M&A in the Singapore office of King & Wood Mallesons. For those of you who don't know us, KWM is Asia's largest headquartered international law firm. And in the Singapore office, we are very much focused on cross-border M&A for the region as a whole. That means strategic M&A and private equity and venture capital investments, which has taken us to emphasize our practice in tech and fintech investments over the past few years. And in the past few months, I suppose, the telephone lines have been pinging back and forth to our colleagues in the US as SPACs circle this part of the world. And increasingly, we receive a lot of queries from target companies, their investors, as well as venture capital sponsors and PE sponsors or people who would like to launch a SPAC, either in the US or in Singapore.
Superb. Thank you, Nick. And of course, we'll be calling on your regulatory and your legal expertise today. Now, as I mentioned, I'll be moderating our discussion today. So let me just give you a brief background information about myself. So I started my career in the UK, and after law school, I worked for a commercial law firm. Later, I moved to Hong Kong, where I spent around 18 years working in a wide range of roles. I was in-house counsel, a law professor, and also served on 2 government tribunals. I also completed my doctorate in Hong Kong in 2014. In January 2020, I relocated here to Singapore to work as the head of regulatory affairs for a tech startup, and I'm now a partner at Holland & Marie. So this webinar is an opportunity for our panelists to share their wisdom and insights. And we'd also like to use this event as an opportunity to collect feedback from you, the community, on the consultation. So please feel free to share your thoughts in the webinar comments box below. Okay, so let me just give you a brief roadmap of our discussion today. We're going to begin with a brief SPAC's introduction to set the background. We'll then dive right in to consider the relevance of the Singapore Exchange proposed regulatory framework. After that, we'll look at the proposed admission criteria and investor protection safeguards. We'll then be discussing other factors that might persuade or dissuade the listing of SPACs on the Singapore Exchange. And then hopefully we'll have some time remaining to mention some of your comments and answer some of your questions. So let me start with some brief background information on SPACs and SPAC regulation to set the scene for our discussion. So in simple terms, SPACs are publicly traded companies with no prior operating history, revenue generating business or assets. They exist for the sole purpose of raising funds and acquiring a target business. When a target business is identified, it combines with the SPAC, usually by a merger. And this process is known as the business combination or the de-SPAC. So we'll probably use these terms interchangeably. Once listed, the SPAC has a specified period of time in which it needs to combine with a target company. And if it doesn't, the SPAC has to be liquidated and the funds returned to public shareholders. So as Frank mentioned earlier, we've seen a number of high-profile companies opting to list on the US exchanges via the SPAC route. So the recent Grab SPAC is, of course, helping to generate a great deal of attention, but also optimism in Singapore. And in response, we've also seen a number of exchanges expediting their steps to list SPACs. So on the 31st of March this year, Singapore Exchange launched its public consultation. And on the same day, the UK Financial Conduct Authority also released a statement to confirm that it would shortly begin a 4-week consultation. And they aim also to implement new rules or guidance early in the summer. In Hong Kong, of course, the Securities and Futures Commission and the Hong Kong Exchange announced that they're also studying the feasibility of SPAC listings. And it's expected that the consultation paper will be ready for release in June. The Indonesian exchange, IDX, has also announced that it intends to pass regulations to allow SPACs to list by July earlier in this year. So it seems that there's somewhat of a SPAC framework race taking place. And although SPACs are receiving an incredible amount of attention from all angles at the moment, they're not a new phenomena. So in the US, they were first administered on the over-the-counter bulletin board in the early 2000s. And by 2005, SPACs were allowed to list on the American Stock Exchange. But it wasn't until May 2008 that the SEC approved the New York Stock Exchange to list SPACs. And shortly after, in July 2008, NASDAQ was also approved to list. So with that background in mind, Michael, I know that you've written about the resurgence of the SPAC in a recent publication. And more specifically, you said, and I actually quote, "With the bar for a traditional IPO as high as it is and seemingly getting higher, there is a strong need for alternative paths to liquidity." So Michael, could you tell us a little bit more about the resurgence of SPACs and perhaps elaborate on their role as an alternative path to liquidity?
Sure. So it's been very interesting. As Claire pointed out, the SPAC, what I'll call SPAC 1.0 in the US was really in the early 2000s, and around 2005 to 2010 is when you saw, the first wave of SPACs hitting the US market. And the peak of that wave was 2007, when 65 SPACs raised approximately $11.6 billion. In this new wave, it's been very, very interesting. You've really seen a huge pickup in the SPAC activity, where in 2019, you had 59 SPACs raising $13.6 billion. By last year, that jumped to 248 SPACs raising $83.4 billion. And then 2021 was off to an incredible start. Within the first month, you actually had more SPACs than there was in all of 2019. And within the first quarter of 2021, you actually had more SPACs than all of 2020 combined. So there's been this incredible resurgence in SPACs. And as I pointed out before, I think one contributing factor is you'll notice that a lot of the SPACs are happening in emerging growth sectors, and particularly in tech. And one of the unique dynamics here in the US market is that the bar to get public for tech companies has gotten unusually high. So if you look over the last 3 years of venture-backed technology IPOs in the US, it's fascinating to see that basically 2018, 2019, 8 or 9 out of 10 IPOs were unicorns. And there actually weren't that many IPOs. Over the last 3 years, you really have only had anywhere from sort of 15 to 25 venture-backed tech IPOs. And the only companies that are going public are the biggest and the best. As of 2020 and through all of 2021, 100% of the venture-backed tech IPOs in the US are unicorns. So there really hasn't been a lot of liquidity for the thousands of venture-backed companies. And this resurgence of SPACs has enabled a lot of these companies to get liquid. A lot of these companies have been around for 10 or 15 years, have had venture backers who have been in for 5, 7, 10 years and need liquidity. And the SPACs are enabling these investors, as well as the management teams and their employees, to get liquid. So that's, I think, a very strong contributing factor in this resurgence of SPACs. The recent SEC pronouncement has actually put a little bit of a pause now. If any of you have been following the US market, you've seen the SEC come out with a couple of pronouncements, and most recently saying that they're going to look at how some of the SPACs have been treating the warrants and how they've been treating them as assets instead of liabilities. And so there's this slight pause now over the last few weeks while people try to figure out where the SEC is going to come out. But at this point, from talking to lawyers and other bankers here in the US, the pipeline continues to build. It's just that you're seeing this pause in the actual pricing of the IPOs, but the pipeline and the backlog is as big as ever.
That's incredible insight, Mike. Thanks very much. And you mentioned also that they've been talking with the lawyers, which is an opportune moment to bring in Nick to ask what legal risks could be encountered by taking the SPAC approach as opposed to the traditional IPO route.
Sure. Well, I think everyone is is wowed by the figures from that SPACs put forward and the ability to obtain a quick listing, especially one in the US. And when we kind of put that into the Singapore framework, maybe there are some differences there which we'll come on to later. But I think for any company who is being approached by a SPAC, I kind of say to them there are three distinct phases that you need to look at. There's the pre-SPAC phase, where are you looking at this as just another means of raising capital, as well as getting the ancillary benefits of a listing, in which case there is a lot to do behind the scenes to get your existing shareholder base on board, make sure that they're going to be supporting the transaction and figuring out what exactly the transaction means for them in terms of dilution and their place on the company's cap table and ultimate liquidity as well. And then there are the other aspects, which are mostly, I suppose, financial driven in terms of the metrics, but also preparedness for the IPO, preparedness for listing. That's another topic for another time. But I think the other parts of the preparation, and which could make a deal fall over, which is obviously the last thing anyone wants, is are you ready to be listed in the US? Are there other kind of issues that may come out in the fairly intense due diligence process that will take place? For example, anti-corruption issues in the background that haven't been properly diligenced, or systems and controls which may be missing, which may mean it's just not the right time today to do that SPAC transaction. You may need just a little bit more time and preparedness to do that. And then there's the other two phases, which are the actual de-SPAC transaction itself, and numerous risks and uncertainties that relate to that, principally not just around your own shareholders, but the actual economics. And Mike kind of touched on that a lot there, I think, in terms of SPACs being a very different type of investment vehicle. There are a number of different players, all with different time horizons within a SPAC transaction, and getting those all to dance together to the same tune and get to that successful de-SPAC is not a kind of foregone conclusion. It takes a lot of orchestration, and the more uncertainties there are, and we'll come on to some of that with the SGX rules in a bit, the more it may look like that the transaction is not as rosy as it should be. And then the last phase is the post-SPAC, and we'll see this, I think, in the coming months with Grab as that kind of builds up to the actual listing, but it's also its ongoing obligations. Obviously, we're saying that SPACs are a shortcut to public markets, so that inevitably means that companies are not entirely ready. They may not be fully profit-making or profit-making to the degree that the markets expect. And so maintaining that listing is also going to be a key kind of watch phase in the overall life of this and key area of risk.
Yeah, I couldn't agree more, Nick. There's so many moving parts to this. So on that note, let's move on then and take a closer look at the consultation. So Singapore Exchange published its consultation paper at the end of March, and it's seeking public feedback on the proposed amendments to the main board rules. And the deadline for the submission is 28th of April. So that's next week, Wednesday, actually. So we've got the paper being structured into 6 sections. So after the introduction, it solicits comments on the relevance of the SPAC framework, the admission criteria and other relevant criteria concerning the de-SPAC, safeguards against dilution risks, other investor protection safeguards, and other rules. So let's move on to look at the scope of the admission criteria and also the criteria for the business combination. This is indeed provoking a lot of interest and also a lot of discussion. So I'm going to go back to you, Mike. So first of all, if we look at the admission criteria, we do see quite a few notable differences from the US exchanges. Now, this is especially with regards to the minimum market capitalization, also the minimum public float, minimum issue price, minimum equity proposal. I wonder if you'd like to share some of your comments and comparisons to the US exchanges for us.
Sure. So it's interesting. The SGX consultation mentions a proposed minimum market cap of $300 million Singaporean dollars as sort of a minimum admission criteria. So if you compare that to the US, in the US, there is actually no specified minimum specifically for SPACs. The minimum is actually determined just as part of the standard listing rules and listing criteria for the various exchanges. So as long as the size meets the minimum standard for the NASDAQ Capital Market Board or the NASDAQ Global Market Board, or for example, the minimum market cap for NYSE American or the NYSE Big Board, the SPAC is allowed to list. Now, when you think purely about the actual dollar amount, that's actually a fairly sizable amount. So when I compare that, if I think of that as sort of around 220, 230, depending on what the exchange rate is, US dollars, the average SPAC size in the US tends to fall between sort of the $200 to $300 million range. So if you think about it, there is actually a fair number of SPACs. If you're talking about some of these SPACs that are 150, 200 million US SPACs, that are actually smaller than what you would, than what the minimum criteria would be for SGX. And given one of the factors that SGX actually points out and that most people are aware of is that many SPACs target to do a deal that is sort of a minimum of 3 to 4 times the size of the SPAC. So if you're talking about a $300 million SPAC, you would be talking about a minimum deal size of at least $1 billion. So given that statistic, unlike the US, which has, for example, 300 plus unicorns, in the tech space, Singapore and Southeast Asia doesn't have that big of a universe of target companies that would fall into sort of the $1 billion plus threshold. So, I mean, in 2021 in the US, we now have actually a unicorn being minted every other day. We're actually at the amount of venture funding is a new record in Q1 of 2021, where depending on whose numbers you use, over $70 billion of venture capital money pouring into startups, and again, a new unicorn being minted every other day. So by imposing a minimum $300 million market cap, you could theoretically be severely limiting the target, the universe of target companies.
Yeah, some really good points there. And again, some very interesting comparisons as well. And one other thing that I noted is that SPACs in Singapore are also not permitted to adopt a DCS structure, which seems to be quite unique. What do you think about that, Mike?
So in the US, the founder shares are sometimes done as a separate class. So there would be that dual class share structure. And in that, when you have that dual class share structure, there are oftentimes also things related to it, like anti-dilution provisions, such that when a de-SPAC is announced, there's, the founder shares don't get diluted. The interesting thing on that is sometimes those things can be negotiated away in the de-SPAC process. So although you do have this dual class share structure, it is not necessarily set in stone and prohibitive to doing a deal, because it can be negotiated away, as a number of these other things are. I think we'll touch on a number of other points that come up, but many of these things, the structure of the warrants, et cetera, can actually be negotiated away in the de-SPAC process, depending on the transaction.
Superb. And did you want to say anything about the minimum issue price as well, Mike?
Well, so one of the things that the other thing that you had mentioned that I think is worth pointing out is the minimum public float. So one of the other points in the SGX consultation paper is the minimum public float, which is consistent with what they have as the main board listing criteria, which is 500 public shareholders, round lot shareholders. So if you compare that to the structure in the US, the minimum shareholder, minimum round lot requirement, depending on which board you're looking at, again, NASDAQ, NYSE American, NYSE, that generally tends to be 300 or 400. So in effect, the US bar is actually lower than the Singapore bar. And so this is really a question that I think is going to be very, very relevant to the underwriters, some of whom may be in our audience. I mean, I think the question remains is, do the underwriters for the SPACs truly feel that they can build a book of well over 500 individual round lot holders in marketing a SPAC and a roadshow? I can tell you from in SPAC 1.0 here in the early days of SPACs, the number of investors that were willing to invest in a new product that people were less familiar with, and it was sort of unclear how they would shake out. Many of the underwriters had a huge amount of difficulty coming up with 300 institutional investors. So many of the buyers are hedge funds, and there just were not that many. You also have to keep in mind that for the underwriter to actually certify that they met the minimum 300, you really need to come up with more like 400. Because when they make that attestation, both the SEC and the underwriters want to be sure that, that 2 or 3 of these actual names aren't affiliated with a single entity. So that 300 really became more like 400. And so if you're talking about 500 and, in the Singapore framework, you might be talking about finding 600 or more. So I think, that could be challenging. Today in the US market, it's not hard to come up with 300 or 400 round lot shareholders, but that's because this has been, this is now a well-oiled machine and everybody's familiar with the product. But I do, it would be interesting to get an underwriter's perspective for a new product like this. How hard is it going to be to come up with 500?
And maybe that's kind of part of the different flavor that we have in Southeast Asia around more diverse sources of investment. A lot of family offices here may be tempted to look at SPACs, certainly from what I've seen in terms of secondary share offerings in the region's unicorns. There's a lot of interest in getting into the profile of the company that would be a target of a SPAC. And people are willing to do that in the current construct. So maybe there is a diverse range of investors out there. However, I suppose we do also need to be cognizant of the track record of the number of listings and the liquidity on SGX generally. Very low numbers comparatively to other exchanges in terms of funds raised, numbers of IPOs, etc. And so I think to your point, Mike, in terms of this being a new product, an unknown product, is it a very high barrier to entry to actually get this kind of off the ground in Singapore under the current proposal?
Yeah. Again, so many moving parts, but also so many different personnel as well, and so many other different considerations. So thanks for that, Nick. And that's something that we'll touch on later as well when we look at the Singapore environment, and we also look at what do we expect to see when the framework is actually listed. But let's move on, just conscious of time, because we do see many differences that Mike has pointed out. We do see a lot of peculiarities. So another unique feature is that for a Singapore exchange listing, the SPAC must be incorporated in Singapore. And from my understanding, that's not the case in the US. We do, however, see some similarities. So for example, the suitability assessment factors. So this is nothing new, standard practice. In terms of other similarities between the Singapore proposal and the US regime, Singapore proposes a 3-year time frame from the de-SPAC to take place, and also requires approval from shareholders and independent directors for the de-SPAC, which is consistent with the US exchange as well. But Nick, let's talk about the moratorium periods, because the Singapore exchange proposes 2 situations where a moratorium must be observed. So I wonder if you'd like to expand on that for us.
Sure. So by moratorium, we mean a kind of lockup on transfers of SPAC shares. And there is the first period, which is after the SPAC is listed, a complete bar on transferring shares in that period from the founders and the management team of the SPAC itself. And then that goes into the post de-SPAC transaction, a subsequent moratorium of 6 months for those actors as well. And the ethos behind that is around aligning the founders, the sponsors, management team's interests. I think there is, reading between the lines, perhaps a nervousness that sponsors may kind of raise a SPAC and just flip it on, or kind of get out, or not be interested in seeing this through for the long run. That seems to come in a few places in the rules. Whereas from what I see and talking with my US colleagues, the regime around lockups is really market driven. There is a kind of 12-month moratorium, which has been commercially accepted in practice.
But speaking.
Sometimes we see that kind of tiered towards performance criteria or other regimes which allow for the deal to be structured in a different way and for founders or management team to be incentivized. And this also bleeds across into the de-SPAC as well. We see a very prescriptive 6-month time limit here in the SGX rules, but if we look at the documents that have just been submitted in the Grab transaction, and I think this is public knowledge now, so I can say it, the founder Anthony Tan, he's locked in for 3 years post de-SPAC, and that was just a function of the deal itself. So I think going back to some of the points here in the kind of SPAC 1.0, 2.0, 3.0, this is a moving feast. There is a lot which comes down to the economics of the day when the transaction is struck and the actors who participate in that. And there is a risk of being a little bit too prescriptive and kind of tying it down to what you think is right today, which may not necessarily follow the evolution of how this product is going to evolve in the US and also in other exchanges around the world.
Yeah, absolutely, Nick. Thanks for that. And I think our listeners will find that very useful. It's also important as well to understand the commercial negotiations behind. And again, just sometimes because you have a framework doesn't necessarily mean that you won't negotiate to a higher bar. So on that point, Michael, I think one of the interesting notable differences is that the Singapore Exchange proposes that an independent valuer should value the target business. Now, what are your views on this, Michael?
So I think it's very interesting. And I think ultimately people can have very different approaches to that and have very different opinions. So one of the things that struck me right away from my time working with SGX is how do you value a tech company, right? Mm-hmm. So one of the things that I think people who are familiar with with both markets would note is that valuations in the US relative to valuations in Singapore, there's a notable discrepancy, right? So people, the startup environment here, there's very, very high valuations. I mean, the valuations that you see in the US many times won't be replicated anywhere else in the world. I mean, you might see valuations like that in some cases, and in China, perhaps maybe in India. Mm-hmm. But the kinds of multiples, the kinds of metrics that you see in the US are in many cases very different from the way they are in Singapore. And Singapore investors tend to be a little bit more conservative. I mean, I'll never forget when I talked about deals, when I was with SGX in Singapore, and I mentioned, hey, there's a software company that might be interested in doing a deal in Singapore. We're talking about, they probably be comfortable taking a 6 to 8 times forward, multiple of forward revenue. And the look around the room is, I mean, you could have, it's an oxymoron, but the silence was deafening, right? I mean, you could have heard a pin drop and people looked like they were going to have a heart attack. And, it's a kind of a humorous story, but here now you're talking about a 15 times forward revenue for a SaaS company is actually below average. You have mm-hmm. companies like Unity and Snowflake that are trading at 50 times, 100 times revenue. So these are valuations that some people would probably find incomprehensible. And so I think that will have an interesting effect, right? So when you're talking about valuations of tech companies, is when you have an independent valuer, how are they going to value that company? For example, just using the Grab example, had that been subject to an independent valuer in Singapore, would it have achieved the same valuation, right? In the US, people are much more comfortable with aggressive valuations. How would a valuer, an independent valuation person in Singapore value Lucid Motors, right? Which recently announced a deal at a $24 billion valuation for a company that's been around for 14 years and expects to have negative free cash flow through 2024, right? A lot of people have, people are more used to those kinds of metrics here in the US, I think, than in Singapore. So, what effect might this have? I think different constituents might have very different perspectives. For a US sponsor, they might like that. A US sponsor who's thinking of doing a SPAC might say, hey, look, if everything's going to be done by, if there's going to be an independent valuation expert that's going to be done, and all these things have to go through a valuation in Singapore, we could be getting great deals because the valuation environment, in Singapore is lower than, so we might be able to find great bargains doing a SPAC in Singapore versus, but if you are a target company and as a target company, you would certainly prefer to get approached by a US SPAC than a Singapore SPAC, where you're much more likely to get a higher valuation.
Yeah, superb insights there, Mike. And I think that's also a good segue into the next part of our discussion, because now we're just going to move on to focus on some other aspects of the proposal that also deviate quite significantly from the current practice in the US. So we see that the Singapore Exchange have attempted to build in certain safeguards against dilution risks into the framework. So for example, we see the Singapore Exchange proposing significant deviations from the US regime in terms of the tying of redemption to the vote. So again, Michael, I'm going to call on your US expertise, because I know that you have a good oversight of how this has played out in the US previously. So what are your thoughts on this aspect?
So I think this one is another one of the really big differences between, what might be Singapore versus the US. So the interesting thing is the tying the redemption to the vote is the way things were originally done here in the US. So in that first wave of SPACs in 2005, the early 2000s, 2005 to 2010, that was the way it was done. If you wanted your money back, you had to vote no. And only people who voted no were able to redeem and get their money back. And the change happened in 2010. That was when they actually decoupled the redemption from the vote. So today, what you see and the way things happen today is you can redeem at any time. And this is a big deal. Anybody who comes into the SPAC can redeem at any time. So it makes it really much more like a risk-free call option, right? So you can invest in the SPAC, and then you'll get your shares and you get your warrants, and then you can always just say, I want to redeem, I want my money back, and take your money back out, keep your warrants, and then vote yes on the deal. So that's what happens quite frequently. You'll see a fair number of redemptions, and then people still vote yes on the deal, keep the warrants, and have that upside. So what's interesting is when you look at the success rate of deals in today versus that first wave of SPACs, there's a very, very stark contrast. I can't remember the exact number, so this is somewhat anecdotal, but in that first wave of SPACs, the success rate of SPACs closing deals was somewhere in the order of 20 to 25%. So actually a majority of SPACs ended up liquidating because they were not successfully able to close a deal. Today, the numbers are well over 90%. In fact, I was talking to one banker, and one capital markets banker told me that she thought the number was closer to 98%. So today, now that you have this decoupling of the vote and the redemption, SPACs have a 90+% closure rate. So I think, again, this goes back to some extent, the appetite and conservatism of Singapore investors. And how likely is it, will you successfully close a deal knowing the nature of sort of the typical Singapore investor? If you look just at the US numbers and see that difference in closure rates, 20-25% versus 90%, that's a pretty significant difference. And as a sponsor, forming a SPAC, do you want to do something in a locale where your closure rate might be low, or in a place, in the US where the current closure rate is well over 90%? So I think that's, that could have a very, very dramatic impact.
Superb, great points there. And again, thinking about time, just moving on to look at some of the other additional enhanced investor protection safeguards. So we note that the Singapore Exchange proposes to put in place a liquidation mechanism. And so the event of a material change is the trigger for that liquidation mechanism. So I'm going to call on Nick's legal expertise here to ask him, in his opinion, what would constitute an event of material change, and is material change sufficiently defined in the SGX proposal?
So coming back to kind of Mike's point around risks for sponsors in getting both the SPACs formed and these SPAC transactions away, this is another area where there is potential uncertainty. The examples given in the consultation paper for a material change, and by material change, this means that 75% of the SPAC shareholders have to then vote if a material change happens to continue with the SPAC. Otherwise, an automatic liquidation takes place. So material change has been defined as really just any change which is material. I mean, it gives examples of founders team resigning or management team changing, but ultimately, it's also any event that SGX feels is sufficiently material, and they won't be drawn into detail on that, at least in the framework of the rules. So I suppose we'll see a body of precedents that may build up around this area. But also, I think there is an overall point here, which is SGX does have a number of gating or checkpoints where it can step in if it doesn't like the way that the SPACs are developing or the types of deals they are doing, to just refuse it. Another example is when it comes to the de-SPAC itself. There's no automatic route for the SPAC to then to merge with an entity, and that merged entity to automatically be existed on SGX. There is another set of controls where SGX can come in, and maybe they will publish some guidance on this, but at present, it's open for them to refuse that listing. And so, coming back to Mike's point, if there is not a clear pathway to get this done, and then you throw in all the other commercial angles on the deal, is there a sufficient valuation? Are the existing investors happy? Are the management team at the target sufficiently incentivized? Can we do it all within the regulatory time frames of Indonesia or whatever subsidiary that has a regulatory filing to be obtained? It then puts a lot of weight, I think, on the successful failure of this mechanism. Whereas, I think where we've got to in the US is the SPAC is really just an instrument. It's a financial instrument. People are investing with different time horizons, as I said. It's just the building block to begin with. The end result is this massive injection of capital, and that's, I think, a really important point for this part of the world. Maybe we'll come on to this later about the usage of this technique. But if we can't get it going in the first place, it's a little bit difficult to see how readily this will be adopted.
Thanks, Nick. We're just going to stay with you, Nick, because also we see that the Singapore Exchange is proposing that there should be equitable regulatory treatment. in the permitting of the listing of the target company through the SPAC. So again, just wondered what your thoughts are on this, Nick.
I think this means really there's no shortcut, I suppose, for a company in terms of the quality of that company when it's being listed as a de-SPACed entity. So for SPACs, there should be no kind of shortcuts versus normal IPO companies in Singapore, and for also kind of de-SPAC companies as well. They'll all be held to as equivalent standards as possible in the eyes of the SGX. But as I said just a few moments ago, there is that additional overlay as well of increased scrutiny, which we don't necessarily get. So, for example, the 500 shareholders, that's the most onerous criteria. It does exist under the standard main board rules, but it is the highest bar in the rules themselves. So I think there is an element of nervousness, and maybe part of that is market driven, and the idea to keep the reputation of the Singapore exchange kind of pristine. As we said, I think there is a bit of a regulatory arbitrage going on around the world with various exchanges jumping on this, but there is also caution, and I think the framework we've been presented with really shows that, at least initially, the idea is to go slowly and cautiously.
Yeah, I completely agree. And again, you can see that the Singapore Exchange has really thought about some of these issues as well, and has considered whether to go cautiously on some aspects, but not on others. I mean, it's interesting to see that they also considered whether or not to impose a limitation of the quantum of the sponsors promote. So I know that the Toronto Exchange has imposed such a limitation, but I believe that it hasn't been widely adopted elsewhere. Just wondering, Michael, do you have any views on whether it should be the exchange's responsibility to impose such rigid safeguards, or is the investor better placed to impose such restrictions, perhaps contractually on an as and when required basis?
Yeah, and I think that's a tough call, right? I mean, clearly, SGX wants to do right by the investor and make sure there's all the right protections and safeguards, which is great. And a lot of the proposals make sense, right? The interesting thing is, for example, if you again compare it to the way it's done in the US, for example, some of these things don't exist, right? There's no limits on the sponsor promote, et cetera. But a lot of that can get negotiated away in the de-SPAC transaction. So even though there's nothing mandated by the SEC or the exchanges and their rules and regulations themselves, as the sponsor and the target start negotiating the deal, a lot of things change. And so sponsors can have some of their, for example, their anti-dilution negotiated away. They can have their warrant coverage negotiated away as an incentive to do the deal. So all these things are just different levers that you push and pull as you would in any M&A negotiation. There's a lot more to just what's the valuation, what's the target price that we're going to pay. Everything from lockups, for example, we touched on that earlier. The moratorium or the lockup proposed by SGX is 180-day or a 6-month lockup, which is interesting because in the year it's actually more in the US. That's one where it's actually more restrictive. The sponsors are actually locked up for a year, but once again that can get negotiated away. Sometimes you'll see the standard is 1 year, but it can be done earlier. For example, if the stock trades above a certain price. Right. So if the stock trades above $18 for 20 of the last 30 days, something like that, they'll put in stipulations like that and say, okay, then you will allow you to start unwinding some of your shares. We'll eliminate the lockup starting at 180 days. So I think it can go either way. But the fact is, nothing's set in stone. A lot of these things aren't set in stone in the US. And so even though there are some of these things that look egregious or, unfairly advantageous to the sponsor, at the end of the day, some of those things may go away.
Okay, thanks, Mike. So we're going to move away from the consultation now, and we're going to look at the other factors that might affect the popularity of SPACs listing in Singapore. So in terms of regional activity, as far as I'm aware, the Korean exchange and the Bursa in Malaysia are the only other exchanges in Southeast Asia that currently allow SPACs listings. But until now, we haven't seen a large number of listings on either of these exchanges. So at the start of the webinar, I also mentioned that Hong Kong and the Indonesian exchanges have expedited their efforts to list SPACs. So there will be a range of alternative options in the region. But bringing it back to Singapore, and again, turning to Mike, I know there's been a lot of speculation surrounding the interest levels of investors. So in your opinion, Mike, who do we expect to see investing in SPACs in Singapore?
Yeah, that's a good question. I think that is one of the fundamental questions here is, right, who are the investors? Who is the target market? In the US, both in the first wave and in the second wave, the predominant players are hedge funds. And so, is that going to be the same in Singapore? Who knows? Unfortunately, I'm not really sure how to answer that. But the fact is, right, the huge number of family offices, right, and ultra high net worth individuals, there's an investor base that exists in Singapore that is very different from what exists in the US. And if those are players, if those are the people who are going to compose a decent amount of the investors in these SPACs, and who's going to be doing the pipes, that could have a very, very different dynamic. So the interesting thing is, right, these things all sort of remain to be seen, and that will really affect how some of these how dramatic an impact some of these differences have or don't have in the framework in Singapore versus the framework in the US. The one thing that I would just point out is, if you look at, for example, again, wave 1 and wave 2 in the US, when the only change was the decoupling of redemption and the vote, that had a very, very dramatic effect on the number of SPACs. If you compare the US and the UK, there's only a couple of real big differences. One is, the big one is that trading of shares is suspended once a deal is announced. It's the standard reverse takeover rule that applies in the UK. And with just these one or two differences between the US and the UK, if you look, in 2020, again, there were 248 SPACs listed in the US and only 4 done in the UK, right? And in 2021, and as in the first quarter, there were 180 SPACs in the US and none in the UK. So it only takes a few key differences to skew the numbers, heavily to one side versus the other. So I think that people just need to be cognizant of that. Now, again, is that going to be important to a Singapore sponsor? Who knows? Some of these things may not be that important for the Singapore sponsor. For a US sponsor that's already used to the framework that exists in the US, it could be much more important.
Yeah, great points. I know, Nick, this is a conversation that we were having earlier with regards to some distinctions between the retail and the institutional investors here in Singapore and here and over in the US. So I wonder if you'd like to elaborate on that for us.
Yeah, I think it comes up in a few places in the rules of this kind of public interest test. And I don't know, to Mike's point as well, whether people are imagining it's the kind of man on the street. We now see a proliferation of stock trading kind of adverts on buses and things like that. So there's definitely a democratization of investment happening here in Southeast Asia, and a great desire to invest in NASDAQ or everything. We even saw that in cryptocurrencies. People were ready to kind of invest in anything. But this is a very different animal, and I think what was the promise of this technique is really large-scale funding on an unprecedented level. Obviously, we have the venture capitalists the very large decacorns and the mega rounds that they're doing. And I've mentioned the family offices who want to get into that, whether it's kind of passive investors or kind of take a more active role as venture capitalists themselves. But certainly in the tech space, there is that desire for larger companies, larger investment. Currently, I guess the jury's out on whether SGX has been a venue where those can successfully list. Obviously, there's the Grab transaction itself, which shows that there are also investors from outside Singapore who are very keen to, or outside Southeast Asia, are very keen to invest in the Southeast Asian growth story. So I think where I'm coming to is really, does the SPAC trend actually unblock a number of pain points for investment in Southeast Asia? In other words, does that large wave of capital coming into a regional champion enable it to consolidate across the region and kind of really mint a couple of new kind of champions for the region rather than just one or two selective decacorns? And does that also mean it's not just the tech sector, but kind of the larger investee base as a whole? It's very interesting you brought up Malaysia. I think the 2 or 3 SPACs that occurred in recent times have been in the oil or exploration sectors. So this is available across the board. We talk a lot about tech because that's where the interest is and the high valuations are. But will we see a kind of right sizing of this towards a kind of more mid-market deal where maybe the investors are a little bit kind of less of a hedge fund types that Michael has indicated, but kind of more kind of retail high net worths?
Yeah, superb. So we have more, I think, questions than answers at the minute. So it's great to be having these discussions, because I think when we have these discussions, that's when we start thinking more about the future and the possibilities. And so Nick, Michael, the hour is approaching, so it's time to start wrapping up. Before we do wrap up, I'd just like to ask you both for your one-sentence summary and concluding views on the proposed SPAC framework. So Nick, why don't you go first?
I think for me, I think it's a great start. I mean, there's obviously a lot of thought gone into the proposal, but I think if there is a bit more flexibility, that would probably serve the exchange better in the long run to adapt to global changes and market tensions.
Great. Michael?
I agree. I think there's some really interesting opportunities here, right? There's an opportunity to sort of really break new ground. Just because the way things are done the way they are done in the US doesn't mean that it has to be done that way, in other markets, right? There's no norm, there's no standard yet. And it remains to be seen how it will unfold in Singapore. And everybody wants to get this right. I mean, you can see that a lot of thought has gone into this, and there's opportunities to be early movers and break new ground and work closely with the folks at SGX. So I think for an Asian sponsor, I think this is an interesting and exciting time.
Incredible insights. So with that, thank you very much, Nick. Thank you very much, Michael. I've thoroughly enjoyed the conversation. Thanks also to our audience for joining us. I hope that you enjoyed it too. So please keep an eye out for our future announcements and also publications. And until next time, stay safe and have a great week. Thank you.
Thank you.
Thanks, everyone.